Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for this segment, we have James Ragan, Director of Wealth Management Research at D.A. Davidson, to discuss the Delta variant's impact on the economic recovery, specifically U.S. employment and interest rates. It's great to see you, James. Welcome to Trade Talks.
Yeah, thank you so much, Jill. My pleasure. Glad to be here.
All right, and U.S. jobs growth has averaged nearly 600,000 per month in 2021, but slowed down significantly in August. Where did the weakness come from?
Yeah, I think, just looking at that, not only has it been 600,000 in year to date, but in June and July, the average was about 1 million jobs per month. So we saw that 235,000 job increase in the month of August. And I think it's fair to say it really came from consumer-oriented sectors, looking at retail trade, which actually declined during the month, and then also leisure and hospitality, which was flat on the month. But if you go back and look at June and July, the average increase for both of those months was about 400,000 in leisure and hospitality. So that, that's really hotels, restaurants, bars, and travel.
When we look at the unemployment numbers, is it solely due to the Delta variant, or can it also be attributed to people leaving the workforce permanently, whether through early retirement?
Yeah, I think a large component of that is certainly attributed to Delta. Of course, there's multiple factors that go on, but I mean, I think we have seen just with the slowdown and some of the consumer activity that had some drag on it. But I think when you look at the employment going back to the beginning of the pandemic, I think the Kansas City Fed just did some research that show that there's about 3.6 million people who have retired since the beginning of the pandemic. The expected number based on demographics would have been about 2 million less than that. So I think you've had people that have left the workforce, but when you look at where the job gap is in terms of people that were employed prior to the pandemic, I mean, it's still from some of the leisure and hospitality and retail areas. So I think largely it's due to the pandemic. We also could see there's been some issues with kids being back in school, which has maybe kept people out of the workforce. I think typically too, when you see people that retire, it's normal to have some of those people return to the workforce. This was also in the Kansas City Fed's analysis, and they haven't really seen that. So I think there's the potential for some of those people who have left the workforce, retired early, to come back. But I think there's still a lot of jobs growth, from that's potentially out there away from the retirement side of the market.
And equally as important is the strength of the consumer. Are you seeing any consumer dialing back at all?
I think it's fair to say that, just looking at some of the data through the summer, so that high frequency data, so to speak, I mean, we've seen a slowdown, fairly dramatically in airline travel. Hotel occupancy is down a little bit, less in restaurant visits, but that's declined as well. So we have seen a slowdown in consumer on the services side. Now, we did see a very strong retail sales number for the month of August yesterday. And so, that's, looking at maybe some of the good side of the market. So consumer activity has been strong, but also, has probably been helped by some of the government stimulus unemployment payments that have been out there as well. So I think the consumer is, still doing pretty well, but we've seen a bit of a slowdown from the real strong levels earlier in the year.
With jobs data showing a slowdown and also in some consumer spend, how could this potentially impact GDP estimates?
Yeah, I mean, I think, so consumer spending is still 2/3 of US GDP. It's been actually a little bit more than that since the start of the pandemic. And so about 1/3 of that consumer spending is on goods, about 2/3 of the consumer spending is on services. So that slowdown could leak into the numbers a bit. I think it's important to note too, in the first 2 quarters of the year, when GDP growth, I think, was 6.3% in Q1, 6.6% in Q2, the consumer spending component was actually more than that. So the consumer spending was very strong. It's going to come down a bit from there. And so, to get upside to GDP, it probably has to come from some of the other sectors, which could be business spending, or, inventories have been real depleted. So there's kind of a hope that inventories will be replenished a bit, but that's really problematic right now due to the supply chain issues. So I think there's some potential for GDP in the third quarter to miss estimates. And you've already seen the Atlanta Fed model, the GDP Now model. I think it's at about 3.6% as the other day, which is significantly below the estimate from the FactSet consensus from economists, which is about 5.9% for the third quarter.
Right. And speaking of the Fed and speaking of the economy, what's your outlook on the economy overall? I mean, next week we're going into a key Fed meeting. Of course, we want to hear about what could happen with interest rates, what's happening with tapering, what's happening with inflation. It seems like it's a confluence of, the perfect economic storm here.
Yeah, I mean, there's definitely risks out there, and the market's held up relatively well. I mean, I know we've pulled back a couple percent on the S&P 500 from the highs in here. We still feel there's a cyclical recovery at hand for the U.S. economy. So getting through some of these challenges now with Delta slowing consumer spending and the supply chain issues. But interesting, if the supply chain issues continue through 2021, that actually helps 2022 because there'll be a big need to replenish those inventories across the economy. But looking at the consumer, historically, the consumer contributes about 2% to annual GDP. I mean, if we're looking at a GDP rate, somewhere around 2.5%. So we've been running above that. But we do think with the pullback in the consumer a little bit in here and the lack of government stimulus, that that V-shaped recovery that we've seen since the depths of the pandemic is going to start to level off a little bit. But we think the consumer is still in pretty good shape. The balance sheets are strong. So when you look at 2022 or in 2022, I think the GDP estimate is about 4% now, and maybe it comes in a little bit less than that, but it's going to come from the consumer. It's going to come from businesses investing to take advantage of the global recovery, and it's going to come from the inventory replenishment. So, because of that, we think that cyclical recovery is still intact.
Yeah. And James, it's interesting when you think about the fourth quarter, we're hearing it not just in financial media, but media in general with the supply chain shortages and what it could mean for holiday 2021 and being able, the stores don't even have the inventory that they should have had now for the holiday season. I wonder if consumers might be, I can hold off on an electronics purchase. I can hold off on that new stove until 2022 when I know the supply will be replenished if 2022 is the year for that in fact to happen. So you wonder if there's some short-term pain in Q4 and it could, towards the latter half of 2022, you can really see the demand there.
Yeah, I think the potential for that is there. It's interesting. The market does a really good job of seeing through that. So I think it was a feeling that it's just a temporary pullback and that's sales that will be made up next year. Then the market will start to focus on that a bit. But there could be some headline risk if consumers, if the availability of goods just aren't there. And, sometimes consumers it's interesting on the holiday spending, consumers don't usually like to put those purchases off. So they'll look to do substitute products and find other things to buy. And I think there's a lot of data in the last week or so that I think the industry trade groups are saying that it's shaping up to be a pretty good holiday season. And that's because consumer balance sheets are very strong. But we're going to need we're going to need the employment growth to pick up the pace. I mean, if the way I look at it is that we're still about 5.6 million jobs below where we were pre-pandemic. So even if we average 600,000 jobs a month, it'll take about 9 months to get back to that pre-pandemic employment level. So we want to see an average of at least 600,000 a month, going forward.
All right, James, we appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thank you.